It's 2009 and the world is reeling from the greatest financial crisis since the Great Depression. Roughly 8 million people had lost their jobs and nearly 4 million people had lost their homes. I was a young banker back then, sitting in a tense morning meeting inside a Wells Fargo Loss Mitigation office, which was in this obscure industrial park out on the edge of town. So I'm listening to the loss mitigation manager talk, and I was a bit perplexed by the obvious gaps in what he was saying. And being young and naive, I thought a little more context would shore it all up. So I raised my hand and asked a simple question that I thought any reasonable person with my training would ask. And I'll never forget, that's when the tension in the room started to boil over. My boss looked at me like I just accused him of a crime. And what he said next changed the entire direction of my life. Hello and welcome to episode 1 of the Phoenician League podcast. I'm your host, Joe Withrow. It's funny, this show exists because of what I saw within the underbelly of the corporate banking world. And I want to share that perspective with you because I think it matters enormously for how you think about your money and investing right now. But before I get into any of that, let me give you a little context about who I am and where I'm coming from. I have 2 decades of experience in finance. I spent years as a corporate banker, and I spent years in the investment research industry. I'm also a husband, a father of 2, and I'm the author of 3 books. So I'm trained as an investment analyst, and I describe myself as a philosopher and a student of free market economics as well. Now, for me, everything starts with the 2008 mortgage crisis. If you don't remember 2008 vividly, millions of American homeowners just stopped making their mortgage payments. So the banks that held those loans were suddenly drowning in delinquencies. And the government decided the fastest way out was to pay those banks to modify those loans, basically to sweep the mess under the rug. That's where I came in. I got hired by Wells Fargo's Loss Mitigation Department in 2009. If you remember, Wells Fargo was the bank that got in trouble for robo-signing foreclosure authorizations, right? They were just signing off on the foreclosures without ever reviewing the documents. Well, that happened in the building right next to the one that I worked in. It's funny, these 2 buildings are out in an obscure industrial park. You know, the main offices for Wells Fargo, they're in a pristine tower downtown. I worked downtown for a while, so I was surprised when I got hired by the Loss Mitigation Department to find that's not where their offices were. I remember driving into the office on my first day, and I'm wondering, I'm looking around and I'm thinking, maybe they sent me the wrong address. I'd never been to that part of town before. And it did not look like a place where banking offices should be. But then I got to the end of this long road. Sure enough, there they were. The 2 Wells Fargo buildings, loss mitigation on the left and the foreclosure department on the right. These were the only office buildings out there. So the fact that they put those offices out where nobody would see them is telling. That should have been a sign. But after the foreclosure scandal, that's when the government decided it needed the mortgage crisis to go away. They didn't want it in the news anymore. So the various government departments involved in mortgage origination, and here we're talking HUD, FHA, USDA, VA, Fannie Mae, Freddie Mac, they each created criteria by which the bank could modify past due mortgages to get them out of the foreclosure process. Then they told the banks that the government would pay them a flat fee for every modification they did. So all of a sudden, the incentive completely flipped. Wells Fargo laid off a bunch of folks over in the foreclosure building, and they brought in a cohort of young bankers like me on the loss mitigation side. We came in, and they made it clear. Our job was to modify as many past due loans as possible. And here's what I started to notice. Whenever somebody gets behind on their mortgage, late payment fees start to accrue. And then once the loan's past due so many months, the bank sends it to a foreclosure attorney, and then that attorney starts billing for fees and costs. So all these fees just add to the past due balance every month, which makes it harder and harder for the borrower to catch up. Well, I started to realize the bank was not forgiving those fees. Not at all. The fees were going right back into the modified loan balance. So I started to see that we were adding thousands, and in some cases, tens of thousands of dollars to the mortgage balance. Yet, what was happening to real estate prices? At the time, they were crashing. On average, real estate prices in the U.S. fell by about 30% that year. In some markets, real estate prices were cut in half. So the market value of these homes was plummeting. but we were increasing their mortgage balances. I started to realize then that we were putting a lot of people way underwater on their home. But there was never any mention of this. We had these morning meetings where the department manager would go over data points, but none of them spoke to what I was seeing on the ground. So I raised my hand in our morning meeting one day, and I asked a very basic question. Hey, are we tracking the loan to value for these modifications? And loan to value just represents the size of the mortgage as a percentage of the home's value. And good underwriting says that the mortgage should be no more than 80% of the home's value. But I came to see that we were doing some modifications at a loan to value greater than 100%. So my thinking was, somebody should be tracking these things, because otherwise we wouldn't know if the program was helping or making things worse. Well, I found out pretty quick that asking questions was not acceptable. I'll never forget my boss scowled at me, and he said very sternly, "That's not for you to worry about. You just keep your head down and do your job, man." And I was stunned. But then after the meeting, this older gentleman came up to me, and he was a super nice guy. He'd been working there forever. And he comes up to me and he says, "Joe, you can't do stuff like that, man. You got to keep your head down and your mouth shut, or else they'll run you out of here in a hurry." And so as a young guy, I was shocked. I was just trying to do the right thing. But it became clear that this was just a partnership between the banks and the government to make the immediate problem go away. There was no long-term thinking involved whatsoever. That was the beginning of my awakening. But at first, I thought it was just a Wells Fargo thing. So I updated my resume and I decided that, I'm going to get out. I'm going to find a new job, because I couldn't just walk away. I had a mortgage, student loans, and plenty of other bills to pay. So I had to start looking for another job. And what I found surprised me. As it turns out, the corporate banking world is, among other things, a giant gossip ring filled with what I would describe as mercenaries. These people are always just looking to jump to a new job as long as it pays more money. It's very soulless in that regard. So I started to ask around, and I started to hear about new projects and new jobs at other banks. And it didn't take me long to make my move. And sure enough, I managed to increase my salary by over 50% in the process. Plus, at the new job, I would be eligible for bonuses as well. So I thought that was my big break. But little did I know, the rabbit hole runs deep. I'll tell you more in episode 2 next week. But needless to say, that experience planted a seed. And over the years, as I moved from the corporate banking world and then into the investment research industry, that seed grew, and it completely changed my thinking about money, markets, investing, and really fundamentally the entire financial system we all live inside. So we'll pick it up there next week. That's going to do it for today's episode of the Phoenician League. If you found any value in today's conversation, please subscribe to stay plugged into the network. We put out new episodes every week. And if something we talked about today made you think differently about money or investing, please leave a review and let us know. That helps the show reach the people who could really benefit from it. And remember, financial freedom does not start with money. It starts with understanding and a fiercely independent mindset. So if you would like to dive deeper into the topics we cover, I invite you to get on the Phoenician League email distribution list at PhoenicianLeague.com. We often send out detailed written analysis on the various investment opportunities in the asset classes that we advocate, and we connect the dots across what's actually happening in the global economy. And then we host online strategy sessions periodically as well, where we can really drill into how to take full command of your financial future. So stay connected at PhoenicianLeague.com. And until next time, let's stay smart and let's stay independent. This is Joe Withrow, signing out.